Hey there Candlestick traders, I'm Lance Beggs from yourtradingcoach.com. In this video we'll continue our review of the multi-candle reversal patterns with the Bearish Engulfing pattern. I love this one. The Bearish Engulfing pattern is a 2-candle reversal pattern occurring at market tops only, so it's a bearish reversal pattern. The price action leading up to the Bearish Engulfing pattern must be an uptrend. Once again, ignore anything in a sideways trend or a downtrend. The price must be trending upwards. The first candle has a green real body, continuing the trend in the upwards direction. So a trend here, leading to a green candle. And the second candle is a red candle, opening above the real body of the green candle here, and closing below the real body of the green candle down here. In other words, the red real body engulfs the green real body. Confirmation of the pattern is price trading below the low of the red candle down here. As always, more conservative traders may seek additional confirmation through price closing below the low of the red candle rather than just trading below. Whatever works for you when you're back testing and forward testing, once again, is fine. Okay, considering the psychology or the sentiment of the bearish engulfing pattern, who is in control, the bulls or the bears? Now seriously, the name's probably giving it away. Okay, bearish engulfing pattern. However, for those who've had a tough day, let's work it out anyway. The first candle continues the uptrend. Everything's looking bullish. The second candle ideally gaps up at the open. Once again, as with previous patterns, not essential and not possible in some markets, such as intraday forex, where it might be, just 1 pip higher or lower. However, price is now at an area that shows a change in the balance of bulls and bears. Bulls are no longer willing to enter the market at these high prices, at least not with the dominance that they showed before, and some of them may be taking profits and exiting. The bears find these prices attractive and enter the market in more force. The balance of supply and demand has been tipped slightly more in favour of the bears, and price falls. The key to this pattern is the extension of the down move below the open of the bullish green candle here. The bears are able to strike a massive blow to the bulls. I'll see your green candle and raise you one bigger and badder red candle. This will shake the confidence of a number of the bulls, leading them to exit their positions if the pattern is confirmed here, and will strengthen the confidence of a number of bears who will enter on achieving the same confirmation, helping to continue the bearish move downwards. Let's see how the process of candle addition changes a bearish engulfing pattern into a single equivalent pattern. The bearish engulfing pattern is made of one candle of price action, which opened here, moved up to the highs here, and closed here, followed by a second period of price action, which gaps up to open here, moves to the high, to the low, and closes, in this example on the screen, at exactly the same point, the base of the red candle real body right here. The same period of price action will display as a single candle opening here, which is equivalent to the open of the bearish engulfing pattern, or the green candle here. Moves to the highs, equal to the high point of the bearish engulfing pattern at the tip of the shadow, and moving to the lows, which is also the close point in this example, equal to the close and low of the bearish engulfing pattern here. What does this single candle represent? Remember, it occurs at the top of an uptrend. So this pattern at the top of an uptrend. That's right, a bearish engulfing pattern here, through the process of candle addition, becomes a red shooting star. Once again, a bearish reversal pattern. So which is more bearish at a top reversal pattern? A bearish engulfing pattern here, or a dark cloud cover that we looked at previously? Well, the best way to answer this is to resolve both patterns into single candles via candle addition, and then compare the single candles. We established just a short while ago that a bearish engulfing pattern is equivalent to a red shooting star through the process of candle addition, and we established in a previous video that a dark cloud cover was equivalent to a green shooting star through the process of candle addition. Well, in the shooting star video, we established that a red shooting star is more bearish than a green shooting star. So the bearish engulfing pattern is more bearish than a dark cloud cover. It's fairly obvious anyway through looking at the pattern. In the bearish engulfing pattern, the bears were able to push price down to close below the open of the green candle. In the dark cloud cover, the bears did not display such strength. They managed to close the red candle down below the 50% level of the green candle real body, but could not push it down to close below the low. Sorry, below the open. Let's look at some examples. Boeing weekly chart. Uptrend. Accelerating with a large green candle up to the 90 level. Rejected immediately by a large red candle with the real body completely engulfing the previous candle real body. Confirmation through price trading below the low of the red candle leads to commencement of a downtrend. Even if you trade the daily charts rather than weekly, perhaps a signal like this on the weekly chart could be used to give you a bearish bias when analysing the daily charts through subsequent weeks. Euro US dollar daily chart. An uptrend that failed, an attempted retest that didn't quite get as high, failing at the 3300 level. A second retest 3 weeks later, failing again to breach the 3300 level here. On what signal? A bearish engulfing pattern. Leads to a good downtrending move with an opportunity for maybe 200 pips profit. Google weekly chart. An accelerating uptrend. Failing at a massive bearish engulfing pattern. If you didn't want to chase the entry that far down, like seriously, where would you put the stop? Way up here on a weekly chart? I don't think so. You might consider waiting for failure of the next rally at perhaps the doji here or the dark cloud cover here. This gives you an opportunity for much tighter stop and possibly lower risk entry before catching the downward move there. One more example, British pound US dollar 1 hour chart. Previous area of resistance here. We have an uptrend with slowing momentum leading into that same area of resistance. A breakout through the resistance on the green candle here, sucking in a lot of the breakout traders. Then failure of that breakout on the very next candle, the red candle here. Stopping out those breakout traders, perhaps down below the green candle here, and then confirmation of the bearish engulfing pattern through price trading below the low of the red candle, leading to a nice move downwards. That's it for the bearish engulfing pattern. Coming up in the next video, we'll continue with the opposite pattern, which is the bullish engulfing pattern. Simple stuff, these candles. I'm Lance Beggs from yourtradingcoach.com, wishing you, as always, happy candlestick trading.